What a day! What a day! Roller coaster across global financial markets as we start this week. Markets were down a lot, then they were down a little bit less, then they were down a bunch again, then they were down a little bit less again. And the magnitude of these swings across what would seem to be big liquid financial instruments just eye-watering. So, needless to say, the question we ask ourselves is, should we be panicking? Is this the time to panic? This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And that's exactly what we're going to be asking ourselves as we proceed here today, looking at the background for what has happened, trying to understand what exactly is going on here, and then looking forward to the macro event risk in front of us this week and figuring out what are next steps. So let's first of all take a look at the performance from last week, because that, of course, begins this conversation. Today did not occur in a vacuum. We can see last week another significant decline for the major equity indices. S&P down 2.2%, NASDAQ down 3.2%, a dramatic collapse in interest rates. The two-year rate down double digits on the week. Crude oil down, gold up. If you haven't spotted a narrative, it seems to be presenting itself here. Bitcoin down a lot, yen up. All of this painting a story of dramatic risk aversion. And so what we can see here clearly seems to be that worry about recession that we've been talking about. Because what do we see here? Stocks fall. Interest rates come down, implying that there is an expectation that central banks, and in particular the Fed, will react with defense against some kind of a negative economic outturn with rate cuts and liquidity. Crude oil down, as if to say this is cyclical, this is about growth. Yen up, gold up, which tends to happen when you have a situation where yields come down quickly. Obviously, neither one of those things confirm meaningful yield. And so when yields come down, their relative appeal increases. And to put the really big risk-off stamp on it all, the speculative of all speculative corners of the financial markets, the digital assets universe, giving us a sharp leg down in its benchmark asset. So all of this looking very recession-flavored. And of course, this is very much the story that we've seen in financial markets since the beginning of July, when we established that top right there with U.S. CPI data that cemented that the Fed was ready to start cutting rates. We've, of course, heard that narrative now from the Fed itself multiple times, saying risks to growth are now part of their calculus, and they're not just focused on inflation. The risks to the various sides of the Fed's mandate, the growth side and the inflation side, have come into, according to them, better balance. And the tone has clearly shifted. We saw it last week in very clear relief. What happens when negative economic data comes out? This red bar right there was a very disappointing ISM manufacturing number. This bar right here was a disappointing U.S. jobs report. And ultimately, what this move has now done is it's broken the uptrend going all the way back to November of last year, which is when the Fed told us they were done with rate hikes and getting ready to cut once inflation looked like it was well and surely on the back foot, and concerns about growth started to outweigh concerns about the price level. As we look at what has happened here over the past month or so, That seems precisely what has occurred. Disinflation has resumed. The economy has started to weaken. Rate cuts have become all but certain. Their timing has been locked in. And the speculative fuel that powered this move, which is to say, there will be cuts. Now we're just waiting for when, and when will be marked by a downturn in growth that seems excessive relative to inflation. Well, if rate cuts are already fully baked in and their timing is becoming increasingly urgent, what does that tell you about where we are in this story? And indeed, we can see here that since the middle of April of this year, U.S. economic data has started to deteriorate relative to forecasts. And this zero line is critical because, of course, when you get a period that this index is moving down but is above zero, it just tells you it's still tending to surprise higher on U.S. economic data, but by perhaps a narrower margin. So maybe economists are adjusting their expectations. But what you see here is a move below zero. And so what you start in mid-April and what you really start to get carved out by late May going into June is that U.S. economic data is now tending to be weaker than expected. And what that's telling you is the fundamental trend has been altered. Notice what has happened with the relationship between stocks and the Fed policy outlook. When we were looking at this back in April and the data started to weaken relative to forecasts, notice the Fed is saying, we're not so sure that disinflation is occurring in earnest. We're going to hold higher for longer, and adjusted their policy outlook from 3 rate cuts, which is what they said in December and then again in March, to 1 cut for this year, which is what they said in June. Notice what the market started doing. When the data started to turn here and stocks started to rally, the story quickly became not only is it ostensibly attractive that interest rates will be coming down, but they'll be coming down later. There is no urgency. The economy is doing okay. We don't need to cut. Inflation is stuck. This is the promise of future rate cuts, but also that those rate cuts probably mean the Fed has overstayed here and needs to catch up. Note here, the market went even before the sell-off from 76 basis points being baked in April when this deterioration starts right here. And by the top in the beginning of July, we have a lot more cumulative easing on the board. Now we're looking at double that almost, about 160 basis points. That's not because the Fed is perceived by markets to be right in its higher for longer perspective. It is because the markets are saying, well, the longer you wait, the more you'll have to scramble later because this downturn in growth will catch up. And needless to say, that seems to be what we've started to see from there, because as you can see from the beginning of July, the relationship changes. More cumulative easing over 2024, the gray bars, and 2025, the yellow, orange is the sum. The more you get from the easing cycle, the higher stocks go until it snaps at the beginning of July, and these things start moving in the same direction. This is now a market that is convinced of the timing of rate cuts and saying, okay, well, now they're really imminent. So what does that mean? It means that now there's a reason to do them. Not just a maintenance reason, but a growth reason. And it's this context that explains why rate cuts were good before, the prospect of rate cuts, and less good now. As a matter of fact, we can see that we've actually, at this point, moved in favor, significantly so, I might add, of a 50 basis point cut at the Fed's next meeting in September. We can see here that the probability of one cut is at 100%. So if the current rate is up to 550 basis points, or 5.5%, one cut is 16.5% chance. Two cut equivalent, or a 50 basis point move in September, now baked in with a likelihood of over 83%. So the market is by no means confused in its thinking. It is fully expecting for there to be a cut. So there is no speculative interest there anymore. Now it's, why is the cut occurring? And this is why. Making the cut not exactly good news, not exactly maintenance, but actually a cyclical concern. So the question, of course, now is, should this be the time to panic? And it is perhaps at this time that it is also most important to remember that markets don't move in straight lines. And just because we've had this incredible crescendo after a month of developing this risk-off recessionary narrative doesn't mean that there is more free fall in the immediate near term. And we got a bit of a flavor for what might be a release valve just earlier today. ISM service sector data, the service sector, of course, the biggest component of the overall economy, coming in a little bit better than expected and returning to growth. The previous month was remarkable in that for the first time since back here, since December of 2022, we saw that the contraction came for both services and manufacturing. As ever, this is, of course, the ISM index, but it's structured in PMI terms. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. It's a diffusion index. And so what you see here is, obviously last week, the manufacturing side of things looked abysmal, much weaker than expected at 46.8 versus 48.8. But the service sector side, which is about 70% of overall U.S. economic activity, that was a little bit warmer today, as if to say, there isn't a panic here immediately. There isn't a hair on fire moment here for the economy necessarily. That doesn't change any of the dynamics we've seen since mid-April. Growth is certainly weakening and the markets are certainly responding. But the kind of aggressive swings that we saw today need not be extrapolated immediately as a necessary matter of course. And as a matter of fact, this ISM release is the largest and most significant piece of U.S. economic data for the week. From here, things get relatively quiet on the U.S. data front for the rest of the week. What's more, the internals of this report were very encouraging all around. A big pickup in new orders, a big pickup in employment, slight nudge up in prices, but that was perhaps not to be unexpected. And needless to say, when there's a small pickup in prices, but a large one in new orders, a large one in employment, the tone of the report generally relatively supportive. Now, is one report a reason to fully dismiss the recession narrative? Of course it's not. But it does offer a potent break in the cycle of bad news. And from here, perhaps, with nothing else of heavy-duty importance on the U.S. economic calendar, there is room for a bit of a correction. What then is the macro risk ahead? Well, first, there is a monetary policy announcement from the RBA, the Reserve Bank of Australia. As you can see from its last meeting in June, the 18th here, that's this line here, there's been a meaningful dovish shift in policy expectations. We are now looking for at least one cut. In fact, when we ended last week, even that was questionable. But if we look at the cumulative tally here, obviously there was a major shift over the past 24 hours. Now we're looking at 40 basis points in rate cuts, whereas when I was looking at this at the market open yesterday, even it was more like 20. And so, needless to say, now at least one cut on the menu, but that cut is not ostensibly likely to occur this time. In fact, we can see for August only a 5 basis point shift in this curve, so no rate cut being baked in here. Perhaps November looks more likely, and then as we get into the end of the year, more easing enters into the picture. Of course, at 40 basis points, we're essentially saying that 1 to 25 basis point cut is all the way in, and then 15 basis points is remaining of a second cut, which puts the likelihood of that second cut at about 60%. The key here, though, that seems to stand out, if we take the wild volatility of the past several days out of the equation, as central banks are likely to do, is that we have an Australian economy that's been weakening. As a matter of fact, in July, the economy contracted narrowly. This is PMIs here, so sub 50 on the composite index means that taken together with services at near standstill and manufacturing that's still in contraction territory here, after 3 months of slowdown, we got contraction. And that's actually the worst outcome since January. So the Australian economy is already on the defensive, and some amount of dovish repricing was already likely. As a matter of fact, if we look at the way that Australian economic data has behaved relative to expectations, we can see that it has increasingly downshifted here since the start of the year. This is the beginning of 2024 right here. And we can see the data has shifted into disappointment territory. It spent most of the year so far below zero and is now at negative 7.6, meaning it's tending to disappoint relative to forecast. So there was already perhaps some dovish tilt that was there to be had from the RBA. The question perhaps is if it's insufficiently dovish, or if it's no more dovish than was already expected, is there a cause for panic? And of course, the answer there is probably no. So if you get a relatively as expected RBA that doesn't light anything on fire and says, yes, we're probably going to cut, probably going to do it once this year, or at least not at something of that magnitude, by saying, look, we don't want to jump ahead of inflation. It's still coming down. We've only seen one monthly disinflationary reading recently, coming off 4% down to 3.8, but we're still well above our target, and it'll take some time to get there. A sense of urgency might be deflated somewhat, and the markets could be helped to bounce. Next, Japan. Obviously, this has been a tremendous source of consternation here around the financial markets, especially today. Japanese stocks sinking like a rock at the open of the week here. As a matter of fact, if we look at the daily performance for Japan's benchmark Nikkei 225 index, it fell a blistering 12.4%. We essentially went in a day from the lowest level since the beginning of the year to now the lowest level since late October, early November of last year. So in a mere day and a half, really, but I suppose we can say, looking at a daily chart, in 2 days, Friday and today, we've erased all of the November through July rally in Japanese stocks. And much of that has been a rise in the yen. That rise punctuated by the Bank of Japan last week that raised rates here unexpectedly by 25 basis points. And that move coming in the wake of already 3 weeks of yen recovery. So what exactly is going on in Japan, and how might it be interesting this week? Well, we are going to get a summary of what was said at that July meeting that is published this week. And one of the more interesting things here is that when the Bank of Japan issued that surprise cut, what they said was that much of the story was linked to the weaker yen. And indeed, we can see here the yen has been falling, echoing its historic relationship with global yields. The blue line here is the average for the 10-year yield in the US, the Eurozone, the UK, and Australia, so the top 4 economies. And what we see here then is a situation where when the cost of capital goes up, the yen tends to fall. This is because interest rates in Japan have been near zero for the better part of 3 to 4 decades. So when interest rates are going up globally, the carry trade, quote unquote, starts to make sense, which is where people borrow for next to nothing in yen and buy higher yielding assets in other geographies, just because the interest rates to be had for owning those assets are inherently higher. So when global rates rise, the yen falls. Obviously, what we've seen here over the past several weeks, really again since the beginning of July, is global yields have been falling. And so the yen has launched sharply higher as this dynamic is unwound. So when we consider past periods of this, of course, here's one example, same thing, here's another, so forth. And so what we find here, when the Bank of Japan issued its cut, and this dynamic was already well underway, they said, well, the currency has been so weak, and indeed, this right here at the beginning of July was the weakest since 1986. And they were moaning that this is inflationary, that this undermines consumers' purchasing power and thereby hurts economic growth. But of course, with the yen already on the defensive, that made sense. But 3 weeks into a yen recovery, that was somewhat old news. The move had already started. Now, if we look at the structure of Japanese inflation here, we can see most of it is still food. The other big contributor here is now energy, fuel, and utilities. And the last one is recreation, which is discretionary spending. The last major bit here is the transport bit, and that is almost certainly linked to the price of fuel. Now, what's important here is that Japan is an island. It imports close to 60% of its food. It imports almost all of its energy. And so when we look at inflation being built on these kinds of imported items, it's this weakness in the yen and its diminished purchasing power for those imported items that is probably at work. So when the Bank of Japan says we raised rates because the yen looked too weak and was undermining purchasing power and fueling inflation, this is what we're talking about. If the yen is already recovering and the minutes suggest that it was the main story and there's not too much more to it, well, then perhaps the Bank of Japan does not have reason to keep acting with that kind of aggression in the near term, at least, because the move in terms of the yen rebounding is already very much underway. And so again, you might get, as with the RBA, a piece of news that says, hold on, don't rip your hair out just yet. This is not a panic. The Bank of Japan has already done what it's needed to do. It generally likes to ride the market's coattails as opposed to fight them. So it isn't surprising they chose to hike after 3 weeks of the markets already going their way. And this might give a little bit of relief in that the absence of urgency from the Bank of Japan would mean maybe the yen pulls back a bit. And maybe that offers some relief to Japanese markets and things settle some. And finally, there is economic data out of China. We're going to get the trade balance report for July. We're going to get inflation. And we can see here the expectations are for slightly better readings, a bit faster growth for exports, an upturn in imports expected. On the inflation front, a bit firmer, though still very much anemic. PPI basically in line. Now, it is certainly the case that Chinese economic data has been doing increasingly poorly relative to forecasts, and so weak numbers seem like a reasonable thing to occur here. But they don't need to be catastrophic to be weaker than expected. In fact, weaker Chinese economic data has been a story, shock of shocks, since April, the same time that we got the turn in the US and much of the rest of the world in the business cycle. And so as long as these numbers aren't catastrophic, again, the urgency of the move seems likely to give way somewhat. Is that then the buying opportunity of all buying opportunities? Well, perhaps not, because the trend is over. And the new one is now, by definition, a series of lower highs and lower lows. So the bias now is down. But if we were to get a bounce from this support here, perhaps somewhere into the 53.50 area or even the 54.30 area, a better selling opportunity into this down move, having moved off these panic levels, might well be with us at some point this week. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that looks at the Wall Street close with myself, Dylan Radigan, and Chris Vecchio, and tries to figure out what may come next. I'm on with Victor Jones for The Price of Truth on Wednesdays, on with Chris again on Fridays for Futures Power Hour, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow. See you then.